This is how you could have made $1,600 in about 23 minutes trading the NASDAQ today. The first thing you'll notice here is that the market formed a dealing range, right? It took out this high and we took out this low here, right? We also took out this high here and this low is taken out. Whenever a high and a low is taken out in one price run, we form what's known as a dealing range. So if you put a grade or Fibonacci retracement on your range, what you'll essentially notice is the 50% level of the dealing range. Anything above 50% of our dealing range, you should be short, right? That's a premium market. Anything below 50% of our dealing range, you should be buying. That's a discount market. However, you have to know what your bias is. Going into this day, you should have had a bearish bias for the reasons that we formed here a 4-hour sell side imbalance, buy side inefficiency, which you can go ahead and mark here. We also formed one on the 1-hour chart, right? And so we traded back into that Monday and then we rejected it, and we had been respecting it going into our overnight trading on Monday and into the Monday morning session. What you also notice is that we formed some buy side liquidity here at this high from 1 p.m. So that was essentially going to be a draw for the market to trade into. Knowing that, a great opportunity after taking these stops would be any short opportunity above 50% of our dealing range, right? Because that would be a premium market, a great area to get short. The market always looks to reprice back into a premium before continuing lower, or reprice back into a discount before continuing higher. So at this point, going into Monday night, we can fast forward this action and see what happened. We kind of consolidated going into Monday night and then into the New York session open on Monday. You can see we started pushing higher. So we trade there and ultimately go and take out these stops when the market opens at 9 a.m. We trade into the 50% level of our dealing range, but we close below this high, which essentially indicated that the market was just coming up here to take these stop losses. It was not coming up here to continue to trade higher. It's just coming up here for liquidity and to reprice back into a premium and to rebalance this 1-hour gap. So that's why the market moves. It's going to rebalance or it's going to seek liquidity. So if we go into our 1 minute time frame, we can kind of see where the trade opportunity would have been this morning. So you can see once the market traded higher, we took those stops that were here, we come down, and now there were more stop losses above here, right? Once this sell-off happened, there were more stop losses that were here that the market was now going to seek before making its move lower. So if we fast forward, we can kind of see how this would have played out. The market takes those stop losses, trades a little bit lower, and then goes and takes these highs again. So there was a lot of manipulation going on before the real move of the day happened. And you can see here, we're trading in a premium market, right? We're above 50% of the dealing range. So now we should be looking for short opportunities at this point, right? So essentially what you should be looking for is for the market to have a change in state of delivery, right? Either we begin to put in bearish fair value gaps, right? Sell side imbalance, buy side inefficiencies, or we have a shift in market structure here. So you can see the market then puts in a bearish premium array here. So this essentially validates now that we have a change in state of delivery. Once we put in this gap here, right, and it stays open as a breakaway gap, now we should be looking for sell opportunities, right? We now have a market structure shift. We trade below this low, a change in state of delivery. So now we're looking for sell opportunities. We trade back into this, and then we trade lower and form this order block here. These two up close candles that traded into this order block essentially formed a proportion block that you could have now looked to play on the retest. So once we sell off here, now we're trading back into a discount. Once we return back in here, we should be looking for opportunity to sell. So when we trade back into here, you could have sold short on this retest of these series of up close candles with your stop loss above this high, right? So if I mark this out, you could have entered short here, stop loss essentially above here, because this is a breakaway gap. It shouldn't get traded into, so we wouldn't need to put our stop that high. Stop loss above here, targeting these lows and potentially even these lows here for about 80 points. So you can see the market then retests this series of up close candles here, and then we begin to trade lower and a little bit lower, and then we begin to trade back higher. We retest this order block here, right? And we never even close above it, because now we're in a sell program. The market should be respecting these bearish order blocks, right? The market should be respecting them and not trading above them. So now we kind of consolidate here, but again, the market goes to retest the premium area. It's repricing back into a premium before continuing to sell off. We kind of get some consolidation here, but ultimately we do get that sell off here. Now we can look to target these lows here, which we get here. We get that delivery here and the next set of lows here. And you could have exited this trade here for about 80 points or $1,600 in about 23 minutes.